Hey everyone, and welcome. Today, we are doing a visual breakdown of Raymond Zucaro's July 2026 market thoughts. We're going to unpack his macro synthesis, and let me tell you, it's absolutely fascinating. We'll be looking at everything from, sweeping historical parallels to some hyper-specific modern-day currency interventions. We aren't just skimming the surface here. We're going to get right into the actual mechanics of how global capital is flowing, and more importantly, why it's moving that way. Zucaro covers a ton of ground. He ties the technological ambitions of the 18th century directly to the intense semiconductor race we're seeing right now. Plus, he breaks down the Federal Reserve's latest moves, all this market confusion, and some literally unprecedented actions by the U.S. Treasury in the foreign exchange markets. It's a brilliant interconnected look at how global markets actually function today, and the stakes for navigating this landscape, well, they really couldn't be higher.
Okay, let's dive into this. To make sense of everything, we've got an agenda with four main thematic pillars for our journey today. First, the history of tech restrictions. Then, we'll look at the Iran standoff and oil. Third, decoding the Warsh Fed. And finally, the U.S. currency arbitrage.
All right, Section 1, History of Tech Restrictions, Echoes of the 18th Century.
So to really grasp the dynamics of today's cutting-edge semiconductor market, Zucaro points out that we actually need to rewind about 250 years, because the nature of state competition rarely changes. Back in the late 1760s, British Prime Minister William Pitt famously said, "The colonies should not be permitted to manufacture so much as a horseshoe nail." Basically, the British Empire desperately wanted to keep the early U.S. totally backward, dependent, and agrarian. They tried to monopolize all industrial knowledge with a strict embargo on textile tech. But then a sharp young apprentice named Samuel Slater just memorized the intricate designs of English textile mills. He bypassed the embargo, brought that tacit knowledge across the Atlantic, and essentially kick-started the American Industrial Revolution. The big takeaway here, no matter how hard an empire tries to lock down technical know-how, knowledge just inherently wants to move, adapt, and proliferate.
And this brilliantly illustrates the modern parallel Zucaro is drawing between that 18th century British textile embargo and the 2025 U.S. advanced semiconductor embargo against China. Now, sure, it's not a perfect one-to-one match. Modern semiconductors involve massive national security issues, fragile supply chains, and multi-billion-dollar industrial policies that the British Crown couldn't have even imagined. But the underlying macroeconomic dynamic? It's exactly the same. We're looking at two historical attempts by leading global power to permanently freeze their technological lead simply by restricting the flow of vital engineering knowledge.
So, how effective are these heavy-handed restrictions today? Well, in 2025, the U.S. aggressively restricted advanced semiconductor exports, but jump forward to just July 28, 2026, and Reuters is already reporting that China has started mass production of domestically developed immersion deep ultraviolet, or DUV, lithography machines. Let's just pause on why that is so monumental. DUV lithography is the absolute backbone for advanced chipmaking. Developing it internally from scratch at a mass production scale in just about a year of severe export controls, that is a staggering pace of engineering bypass. It proves Zucaro's point beautifully. Trying to freeze a tech lead by restricting information usually just catalyzes self-sufficiency in the targeted nation. The tacit knowledge migrates and adapts just like Samuel Slater's mill designs did all those years ago. Which brings us to a really fascinating philosophical point to wrap up this first section. While protecting IP is obviously huge for corporate profits, Zucaro highlights an argument shared by rapid innovators like Elon Musk. He suggests that patents and state embargoes can sometimes act as artificial blockers that actually hinder overall human progress, often signaling that a company or country just isn't innovating fast enough organically. Ultimately, natural growth and fierce open market competition usually outpace top-down restrictions. As an investor watching global tech, betting on the entity trying to out-innovate its peers is historically a much safer bet than betting on the one trying to legislate away the competition.
Moving on to Section 2, Iran standoff and oil, Geopolitical Volatility.
Here, Zucaro analyzes the macro impacts coming out of the Middle East, mapping out the specific geopolitical events driving recent market volatility under the Trump administration. First, you've got that highly publicized Memorandum of Understanding signed at the Palace of Versailles. Despite the historic venue and initial market optimism, Zucaro notes this agreement completely collapsed in less than a month, instantly wiping out any stabilization in energy futures. Then, layer on the compounding impact of social media claims. Zucaro highlights how unverified claims, like that major diplomatic gaffe about the Islamic Republic of Japan allegedly firing missiles at a U.S. aircraft carrier, continue to heavily skew algorithmic trading. This constant whiplash, violently transitioning from historic peace treaties to unverified missile attacks in just a matter of weeks, keeps oil markets incredibly destabilized and risk premiums dangerously high around the Strait of Hormuz.
So, what does this chaotic volatility actually mean for an investor trying to map out their portfolio? Well, because of this continuous, unresolved disruption in the Middle East, Zucaro maintains we are firmly stuck in a higher-for-longer environment for energy prices. But the crucial takeaway is how specific companies are utilizing this environment. This creates an extended, highly lucrative profitability window, especially for high-beta emerging market oil and gas producers. Because they're suddenly pulling in revenues way above their multi-year forecasts, they're using this runway to actively optimize their capital structures. They aren't just hoarding cash, they are aggressively paying down long-term debt, executing share buybacks, and building fortress-like balance sheets. For astute observers of emerging market portfolios, this geopolitical tension is inadvertently forging some of the absolute strongest corporate balance sheets in the sector's history.
All right, let's bring it back to domestic monetary policy. Section 3, Decoding the Warsh Fed, a tight-lipped strategy. Now let's analyze that highly anticipated July 29th Federal Reserve meeting. This was a critical moment because it was only Kevin Warsh's second meeting as Fed chair, and global markets were scrutinizing his every move to figure out his baseline behavior. What unfolded was a really jarring contrast between his words and his actual deeds. Back in June, during his first meeting, Warsh was incredibly hawkish, projecting strength against inflation. But in July, despite explicitly claiming that price stability remained his primary focus, he completely failed to act in any tangible way on stubbornly high price levels. This tight-lipped, contradictory style, it left the market totally confused. For a central bank, credibility is your most valuable asset, and allowing a widening gap between tough talk and passive policy just creates immense macroeconomic anxiety. And I really want to highlight a very specific piece of data from that meeting. Exactly three voting members on the committee were actually in favor of raising rates, so this was absolutely not some unanimous consensus to pause and wait for data. It reveals a clear, undeniable fracture within the Federal Open Market Committee. It signals to the bond market that even with significant internal support to fight sticky inflation, Chairman Warsh actively chose the path of inaction. The market's reaction to this deliberate inaction was immediate and highly instructive. Rates moved noticeably higher on the belly of the yield curve and on the long end as well. Why? Because when the Fed refuses to hike rates despite stubborn data, the bond market instantly starts pricing in the fear of unanchored inflation down the road. Investors demand higher yields to compensate for that future risk. But perhaps the most vital global reaction was this third point. The US dollar weakened across the board. When the leader of the world's reserve currency talks tough on prices but won't pull the trigger on rates, foreign exchange markets instantly call the bluff, and the dollar softens. And this specific dynamic leads Zucaro to a really compelling, kind of controversial theory. What if this apparent policy mistake wasn't a mistake at all? What if the Fed's inaction is actually a deliberate debt-to-GDP strategy? By definition, this is a stealth macroeconomic approach where you slowly and quietly weaken your national currency to manage impossibly high domestic debt. Given the massive historic sovereign debt the U.S. government is carrying right now, a weaker dollar fundamentally makes that debt mathematically easier to service. It's basically a stealth tax via inflation and devaluation that avoids explicit default. Zucaro suggests that maybe Warsh's confusing July meeting wasn't about missing the mark on inflation, but was actually a calculated, overarching strategy to devalue the nation's crushing debt burden.
Which brings us to our final thematic pillar. Section 4, the U.S. currency arbitrage. July 31st, market interventions.
This seamlessly connects right to our domestic policy discussion. If the U.S. is structurally comfortable with a shifting, weaker dollar, it sets the stage for some incredibly aggressive international moves. Just 2 days after that confusing Fed meeting, on July 31st, the U.S. Treasury stepped in and executed what Zucaro calls a hedge fund-like arbitrage trade in the foreign exchange markets. We really need to underline how wildly unusual this is. Central banks intervene to manage rates all the time, sure, but the U.S. Treasury? Their primary job is simply to issue debt and fund the government. For them to actively play an aggressive cross-currency arbitrage game is a complex, direct market intervention that signals a huge shift in global financial statecraft.
Let's move to and see how this builds, step by step, so we can clearly grasp the sheer scale and audacity of the capital flow here. Step 1. The U.S. Treasury actively enters the market and sells euros in massive quantities. Step 2.
They immediately take those euro proceeds and aggressively buy Japanese yen. Step 3. The direct mathematical result is a massive engineered boost to the value of the yen, funded entirely at Europe's expense by depressing the euro. It is a highly calculated multi-leg arbitrage trade right out of a ruthless Wall Street playbook, but executed with the infinite capital weight of the United States government. Crazy, right? So why on earth would the U.S. Treasury execute this specific cross-currency trade? The geopolitical context provides the answer. Japan has been facing massive structural economic issues with a dangerously weak yen. Normally, when a currency weakens too much, that nation's central bank is forced to liquidate external assets, primarily their massive holdings of U.S. treasuries, to raise capital and defend their home currency. The U.S. desperately does not want Japan dumping billions in U.S. treasuries onto the open market right now because that would crash U.S. bond prices and spike domestic interest rates. So the U.S. just intervened to artificially boost the yen themselves, saving their own bond market. But here's the major fallout. They did it by selling euros, effectively throwing the Eurozone under the bus. In standard G7 macroeconomics, a move like this requires months of coordinated global agreement. Instead, Europe was merely informed of the move after the fact. It demonstrates a U.S. Treasury utterly willing to act unilaterally and breach standard decorum to protect its own bond market, creating immense long-term trust implications among its oldest European allies.
Which leaves us with this final, overarching question to ponder as we wrap up this macro synthesis. Are these aggressive market interventions actually working, or are they just creating compounding, uncontrollable volatility? Think about it. From 18th century-style tech embargoes that just seem to spur rapid foreign innovation, to unpredictable geopolitical treaties that collapse in a month, to unilateral, hedge fund-style currency manipulation by the U.S. Treasury, we are watching nation-states aggressively and heavy-handedly intervene in delicate global systems. As Raymond Zucaro's analysis outlines so clearly, these blunt actions always carry profound, often highly unintended consequences. It is a deeply interconnected macroeconomic landscape out there right now, and one that absolutely requires us to look far past the daily headlines to understand the deeper structural mechanics at play.